Hi, I'm Matt Wilhelmi. I'm an industrial organizational psychologist, and I'm also the vice president of consulting partnerships at Entromy. And today I'm joined by Scott Dunklee of the Lancer Group. Scott, how are you?
Great. Appreciate you making time.
Yeah, of course. Well, Scott, you and I are working towards a private equity panel, and just wanted to spend some time this morning going over a few kind of introductory questions. Let's just jump right in. I was hoping maybe you could share a brief overview of your background and some of the experience you have in the private equity space.
Perfect. So to keep it brief, Matt, probably 2 points to keep in mind. One, we're a professional services firm that is focused on doing senior level headhunting assignments, recruiting assignments for portfolio companies that are owned by private equity. And we also do some of the value creation searches at the private equity funds themselves. So that's point one. Point two is we are primarily focused on working with software companies, or what we think of as tech-enabled companies. That's our deepest area of expertise. And then point two, we were actually one of the first search firms to connect the dots of an opportunity between private equity firms investing in software, which really was not a thing until circa 1999. So we have been in the business a very long time. We used to do both venture capital and private equity portfolio company searches, but we really pivoted and moved exclusively to private equity going all the way back to 2002. So we have seen the evolution of the private equity industry and also just the maturity of that industry as it pertains to our world.
So, Scott, it sounds like you've got a lot of different experiences. Could you tell me a little bit more about maybe your area of expertise when it comes to private equity transactions?
The soundbite would be, think of us in two ways. You are a private equity firm. You're principally focused on getting deals done, but you want someone who works for you in, let's call it a value creation role, whether that's an individual contributor or an army of value creation people, as we've seen some of the larger private equity firms form. So we help them find those kind of people who are focused on the operational improvements of the companies that they buy. We are not recruiting deal people that are sitting in front of an Excel spreadsheet all day. So that's at the firm level. At the, call it the portfolio company level, meaning the private equity firm is looking to buy a company, then they buy a company, and now there are changes in the senior executive team for whatever reason. That's when they would call us and say, Lancer Group, we need a new chief financial officer. Lancer Group, we need a new chief executive officer. And that's where we would come in. And again, largely focused on SaaS and software, and then what we think of as tech-enabled services.
So, Scott, I'm wondering, with all this experience and doing all these different placements, what are like the most critical factors for ensuring success in a private equity deal?
So great question, Matt. If we had that bottled up, that would be a terrific solution. Keep in mind the industry has matured significantly since the storied days of the first decade of the 2000s, when private equity was first getting into doing software deals. Those were some of the largest returns, right? Money on invested capital, and made a lot of the first generation of private equity deal partners very, very wealthy. Now, as that industry has professionalized and matured, competition is white hot at the private equity firm level to win the opportunity to write a large equity check to then buy a company. So that's been a trend for several years. That trend has exacerbated. It is now extremely, extremely competitive. It's difficult to get a deal done. Last year, a number of our clients, the deal teams, spent the entire year trying to buy a company that they would lose at the last minute of the auction and didn't get a single deal done. So it's difficult to get a deal done. In the old days, you could get a deal done and you spent all your time trying to figure out, is this a good deal? Once we own this, will this be a good deal? Now there's so much competition to get a deal, an enormous amount of time goes into triangulating to win the deal. And in many cases, your competitors are going to accuse you of massively overpaying to get that deal done. Now you've paid a very, very high price for something. Now you own it. And so over the next 5 years, something significant has to take place to improve the economic performance of that company, or you will have egg on your face at the end of the exit period and not be able to raise a new fund nor give money back to your limited partners. So that's been a major macro change.
And so when you're thinking through these macro changes, can you share an example of a deal that you worked on where these factors played a pivotal role?
So we obviously can't talk about specific deals, but it is fair to say, and I'm gonna be narrowly talking about deals that got done and really the SaaS. Let's just pick on the SaaS deals that got done with post-COVID lofty valuations. So poster child of those, remember the SPAC mania was still going on but tapering, and then many private equity firms were buying SaaS companies in 2021 particularly at very high valuations. Interest was still essentially zero, so debt money was essentially free. And then we saw the public market correction occur for technology stocks in Q1 of 2022. And because private equity is private and does not have a public market day-to-day mark-to-market, you had companies, private equity firms, I should say, own companies that essentially said, uh-oh, our debt service was zero, now it's tripled, right? Oops, that's in the forecast, or that was not in the forecast. And the market growth is tapering off. So that was a bit of a perfect storm that has led to what you see today, where companies just simply have not sold assets, because if they do, they would have to demonstrate a less than stellar performance. That doesn't look good to their limited partners. At the same time, limited partners are saying, hey, where's our money, right? We need that money. That's how the cycle works. So those are some of the things that we see at the macro level, and we don't have time to go into it, but at the headhunting level, there has been a corresponding number of executive changes, right? As people were politely asked to leave and bring in a replacement, especially in CEO, especially in the head of sales or the go-to-market roles. Those have had heavy turnover last 12, 24 months.
So Scott, when you're thinking about participating in this panel, I'm curious if maybe you could share, what's exciting you the most about it and really what unique perspectives you hope to bring to the discussion.
On unique perspectives, as you know, Matt, there is nothing new under the sun, so I'll underpromise on that. But I'm excited about the panel because, as you know, in the old days, everything that we do, most of the things that your panel members do was all under the radar screen. There were, YouTube wasn't a thing. And so particularly if you're moving up in your career, you didn't have a specific mentor, you didn't have a place to learn. So I think it's awesome that we have these public forums, panel discussions where you can really talk about unique issues, and hopefully that's another way for people to learn and grow.
So looking ahead, what trends or innovations do you see shaping the future of private equity, and how are you positioning yourself to navigate those changes?
Great question. I'll go back to my comment about the evolution of private equity. Much more competitive, much more sophisticated at the same time. Probably the biggest trend we'll continue to see is more and more science around what happens when you acquire a company vis-a-vis the human capital that's running that business. That's probably the last bastion. It's still, frankly, the Wild West in most firms, most places. Headhunting hasn't materially changed its approach since the 1950s, 1960s. Right? We have a few assessments. Those assessments were written in 1964. None of that technology has changed. That is probably where we're going to see the biggest change. So that's going to be the human capital, particularly at the senior team, but making sure that the senior team understands the value creation plan, number one, and making sure that the employees or the associates of the company at all critical levels of decision making also understand the value creation plan. That our prediction is that will be a bit less of a black box than it is today. So that's probably the major trend.
So that's really interesting. I'm wondering if maybe you could explain just a little bit more about how you think those trends are going to maybe influence the way that deals are structured, evaluated, or even executed.
So the best way I would describe it is from a very sophisticated board member. Think of this person as looking like an operating value creation person. They have a career as a line operator, getting into the details, driving change. in this case in software companies, and then post-career as a line operator have moved into advisory and board/operating partner-esque type opinions. And this person has got many data points of many very successful private equity firms. And the interesting comment from this person was he was very surprised that the case that the private equity firm brings to their investment committee, the IC, he was very surprised that the details of that plan, after a large equity check has been written, a massive amount, equity and debt, right? Let's say $200 million equity check, like debt. So let's say $400 to $500 million of money, debt and equity, have gone in to acquire a company. One would think that the details of that value creation plan that the investment committee approved would get translated into the senior team, right? Fair assumption. And he said, no, actually, you would be surprised. And I said, wait a minute, this makes no sense. And he said, don't get me wrong, everyone at the C-suite knows that the private equity firm needs to make at least X. That's common knowledge. But what they're not always clear on is how does the private equity firm think that they will get to that 3X with specific value levers that should be pulled by the management team during the 3 to 5 year hold period. So that's really interesting. So we expect to see more, call it, clarity of communication to the senior team. And then we think the real pivotal thing is how do you get that out of the brain of the CEO and the chief financial officer and the head of sales, and how do you get it down to the line managers who must drive this day to day. So we're expecting to see that over the next 12 to 36 months.
Well, Scott, we're excited about that trend as well. More to come on that. I'll leave the audience hanging just for a little bit, hoping that they tune into our panel discussions coming up. But as an organizational insights platform, Entromy is certainly counting on some of those trends that you talked about, really kind of filtering down into, the mainstream private equity discussions. Anyway, Scott, I really appreciate your time today. Thank you so much. Looking forward to continuing the conversation.
Thanks for having me, Matt. Enjoyed it.